Good afternoon, traders. This is Christian from Tribeca Trade Group, and this is your end of day market recap for Thursday, the 27th of March. Well, I'm going to say once again, this was a chop fest day. That does feel like deja vu all over again. Sorry, I am using Yankees quotes today because it's opening day, and there's your Yogi Berra saying. But yes, I mean, listen, I'm trying to make today's video a little bit more more interesting with bad jokes, because the price action is not easy to deal with. It's another day of that. Ultimately, another word that comes into mind besides chop is patience, and just trying not to get too chopped up in this market. There's certain things I'm not going to go into the debate in this video about whether this is a bull market or a bear market. A lot of times I associate bull market characteristics for what we're seeing on a current time frame, not just, the standard definition of a bull market, meaning like breakouts work, strong breadth, a lot of participation in the market, a lot of good trading setups, multiple sectors doing well, defined leaders. And a bear market I defined as, or bear market, I shouldn't say like the standard definition of a bear market, but bear market characteristics are often, not a lot of things working, very defensive areas of the market working. Uh, a lot of breakouts failing and a lot of choppy price action. So yeah, I'm not going to say that this is a bear market, but right now it's acting like a bear market. I mean, there's no doubt when you see just, very, very defensive areas, continuing to do well. Today it was precious metals that did very well. Consumer staples did very well. Substitutes for new cars did well. Anything having to do with auto parts. I had a lot of questions about that. Let me get to the risk disclaimer before I forget. Please read the full risk disclaimer right here, but everything that we're going through in this video is for information purposes only, not giving any advice or recommendations. Everything that we're going through is for information purposes only. But yes, I had some questions about this. I posted a couple things about, what's going on, like the auto parts names are going up, and like anything that has to do with a alternative of getting a new car. So like Uber for a little bit was doing very well. Rental cars were going up for a little while. And that's kind of the theme. Like, don't overthink this stuff. I had some people ask me on Twitter, they're like, well, I don't mean, it doesn't mean that auto parts companies are, they're escaping the tariffs. It's just right now, just a basic knee-jerk reaction. Again, you don't have to have perfect reasoning for every market move. Sometimes it's just something that's simple like that, where, hey, if people can't spend the extra $5,000 to get a foreign made car, then they may hold on to, they may seek alternatives. They may do things like, hey, instead of buying a new car, I'm going to get this fixed in the car and just keep making auto repairs. That is actually good for those companies, regardless of like they're getting their parts from overseas. It's still going to be cheaper for the consumer than springing for a brand new car that could be more expensive. And that's the same thing with Avis and Hertz, which had a big day today. People, hey, I'm going to rent a car for this weekend instead of I'm going to hold off buying a car. And I'm going to instead rent a car a couple more times. I did that for a while. Like I lived in New York City for a long time. I lived just outside of New York City for a long time too. And a lot of times, like I would rent a car. And for the most part, I would be in the city unless I was going to see family. Or you get an extra Uber ride. You Uber more often, to see friends or family. So that's what outperformed today. Then also, I'm not going to go through all these charts, but then like the discount retailers, and that also has like a bit of a common sense or logical trait. Instead of going out to expensive restaurants, hey, you're probably going to do things like, go to grocery stores a bit more, or look at, like, this is one name that I've been long for a bit, and I've been in and out of this trade a little bit. Oh no, I want to go back. Hold on. So that's BJ Wholesalers is a name. I'll go back to those charts in a second. I have a little bit of an exercise here, which I just screwed up here on my chart. So let me fix this. All right, so I'll come back to that. I'll bring up the chart of BJ wholesalers as well as, things like Ali brands and dollar stores did well today. Right? These are the things that, more of like recession type trades as well. Whenever I see Schmuckers go up, right? The jelly company, or Hormel, which which makes spam ham. These are things that are very defensive in nature. So that's a little bit about today's price action. I find it interesting. There's some comparisons to 2018 that I'm hearing, and I wanted to look at that chart first, just to kind of say, is this kind of what we've got going on here a bit? Is it a little bit of a repeat of 2018? Now, again, whenever I compare one of these charts from another period, whether it be 2018 or whether folks for a while like to compare the 2022 market with other market corrections, which, in my opinion, it's not a great comparison. History rhymes, but it doesn't repeat exactly. But there are some lessons that we can kind of take away. Because again, I don't think things are going to, it's the worst analysis in the world. I think if you try to compare tick to tick and say, oh, this happened in such and such time, every different time has a different set of variables. So unless you can create all of those variables exactly 100%, then you shouldn't be surprised that you're not going to get exactly the same pattern that you find in some other time frame. It's impossible. But folks like to do it because it gets people excited because they think that they have a crystal ball or something. I'll move on. This is what happened in 2018, just for reference. We got way extended. Look at the RSI that happened then. And regardless, like this is even good to look at just for the heck of it. But notice how overbought the RSI was. 86. We basically spent the whole first month of 2018 just up and staying above that 5 period moving average. Then we basically came crashing down here and went below that level and found support at the top of the value area for the year, which was that gray box here that you're seeing. So that's exactly where we found support. That also coincided with the 200-day moving average. I like when volume at price lines up very nicely with the 200-day moving average right there. So that is that's that and then we began to kind of recover quite nicely. And that again, it was a little bit different time frame. We actually did the recovery there in February, came back down, got rejected at the bottom of the value area, came down here, made a bit of a higher low, and then made another new high. And then we kind of came crashing down a little bit. And this was April. So the end of March. So again, not exactly what we're experiencing right now. That these timeframes don't line up perfectly, but if you look at where we are now, which is entering April, and where we are here, then we did begin to recover, and there was a little bit of ups and downs, up and downs, up and downs. Not as smooth as something like this was, but still, we had a nice run until we got to until October at that time frame, and then we began to spill down again. And I think that was about trade talks and all of that. And then we began to move back higher again. So let's fast forward to where we are now, and you're going to find that there's a couple similarities. Again, I don't look for exact particulars in here. Well, where are we? 2000. Come on, 2000. All right. So first of all, we didn't have the same type of run up, a little bit bumpier than what you saw in that January 2018, where we went just hyperbolic to the upside. This is a bit different. We hit highs in the middle of February, and then it's been just a methodical, not as fast. This is not as fast as what we saw there. This kind of wears you out, and I think that's also what we're doing in here. Like this is, to me, like I feel a little bit worn out with this because we've got a lot of false moves. We start to move one way and it gets rejected. We start to move another way and it gets rejected. I will say this: what happened to my? It must have done something not right here. Let me check. Let me just check this. So yeah, we're back below the 200-day moving average. That's not a great look. We are still above the value area for for the year, so that's good. But again, this is tough trading. We've had a big gap up on we all the biggest gains that were made this week were the gap up over the weekend. So unless you loaded the boat on Friday with names, then this has probably been a bit of a frustrating market. But that's what the market does sometimes. And again, it's good to kind of go through because sometimes, you know. It feels like, oh, geez, like this is a horrible market to deal with. But if you do go through some of those other times, like I just did in 2018 and showed that big move down in 2019, the market does this from time to time. It's not fun. You got to get through it. And I will say this, if you're not being patient with this market and taking, smaller trades and making some adjustments, what happens to some traders is they fail at these time frames because they're not making adjustments. And I've seen it. I've been running, a trading room for a long time. I traded institutionally for a long time too. Number one, the market humbles everybody. Number two, you're not bigger than the market. And number three, if you're not patient, the market will take you out of the game if you're not careful. Because market pullbacks and corrections can sometimes last for a long time, and you just have to kind of wait it out. And if you are actively trading in this environment, which I am too, I'm trying to be somewhat defensive in what I do. I'm trying not to go too much into growth names because I think those are really going to shake you up because they're moving just erratic, up one day 7%, next day down 8%, up next day up 5%. That's not a healthy environment, and you can't withstand that. Those types of moves. So, uh, and I've experienced that a little bit too, even though I've lessened my positions. I gave examples in yesterday's video that I was in, Spotify and took like two or three targets in Spotify. And then the next day it's down 8% on no news. The same thing happened with Palo Alto, which is a name that I was in. I was like, hey, Palo Alto looks good. Next day, boom, down 5-6%, like no problem. You know, it, this is just it's not in relate. This is not doesn't have much to do with like your stock picking abilities. It just has to do with this environment that we're in and how difficult it is. And also, recognizing that what the market is rewarding a little bit is just the lower volatility names. And those are things like insurance companies and the gold miners and things like that. So bottom line is I'm going on here a bit. I'm going on a little bit of a rant here. Let me get back on page here. And by the way, so the S&P, which again is doing this back and forth stuff, almost like it did last week, in some respect, we are still holding above last week's range. So technically, there's no, that's what I said in yesterday's video, considering we didn't really do much today except chop around and back and forth. Qs again have been showing a little bit of relative weakness. This is inside value. And I would watch the 482.50 level, but we crossed this like 7 or 8 times today, back and forth, back and forth. Again, the observations here, look at the wicks that where we try to go higher. There's still sellers that are just they're not buying it, right? And it could be short sellers, could be some long sellers in here too, but saying, hey, there's no way that this group is going to rally yet. So, what I think that we had earlier, and this is why sometimes you need a little bit more information. But at the beginning of this week, this was a major oversold bounce. A lot of the AI names and higher growth names. Um, rallied hard, but there's was absolutely no follow through, and we've just about filled the gap of that Monday move. I think we did actually fill the gap this morning for the whole move, that whole gap up move. All right, so that's what we've got there. I'll just bring up IWM. Right, IWM, it was kind of quiet today, but that's also filled the gap as well in terms of Friday. So, again, that was very difficult. Again, why am I saying all these things? Because I want you to be realistic. There's so many you're going to get a lot of bad information, from people who are insecure on Twitter, and they're constantly going to tell you that they're doing well, even though they're not, but they're going to make it sound like that they're hitting hitting every turn with this market. And, that's just not humanly possible. But there's a lot of people who will try to make you think that. These are the same folks that don't show you their P&L either. Or if they do, they show you a screen print of, one day that they did well. And then you don't hear about their P&L for like another month until they have another big up day, which that's not really trading. That's not that's not how it works. They're just trying to make themselves feel good because they're insecure people. All right. So again, why do I bring that up? I'm not trying to say anything bad about people, but I'm just trying to, make you understand that there's a lot of tomfoolery that happens in this game. Um, Gold is sitting here at the highs. Again, that has worked really well. And back out to new highs. And again, I think that's a little bit of, why is this going up so much? It's kind of an uncertainty gauge. That's another reason why Berkshire Hathaway is doing well too, because they're sitting on a boatload of, they probably want the market to go down. They're sitting on a boatload of cash. Where's Berkshire? That says, I don't think that's the right thing, but Berkshire Hathaway B. Yeah, something's not right here. Oh, where's the New York Stock Exchange one? Maybe if I go Berk. Trading View's kind of odd like that. There it is. But yeah, I mean, this is also at, new highs. So again, it's kind of a bit of uncertainty on the tape. I mentioned I would go over a couple quick charts. I mean, um, this is a name, and again, I stick to names that had good earnings, but this is a nice little move up here. And again, you're still seeing names like this. CAH had another nice day today, up 2%. Again, these names like CAH, Cardinal Health, and McKesson, these are names that did really well in 2022 as well. They went through streaks where they did very well too. So just bear that in mind. I also wanted to review the China charts because they had a good day. Did not close above the value area. Not to say that I don't like this chart, but again, it's tough to just get really good results right now with this not closing back above its value area. So I remain long I am long China. It's been acting better. In the TTG trend portfolio, I do have gold on. BABA, I would like to see BABA get back above its 20-day moving average. It doesn't look like it's ready to do that yet. So again, patience is key. You just have to be careful if we take out this range here because it's a long way down to the 50-day moving average. That's about 10% down. So we just have to be careful that this doesn't break the range. I also liked what was going on in TIGR. Again, didn't close on the highs. Another area too that I like is Singapore. Right. So again, slower moving. I know this is boring, but at least they're grinding higher. So that's Singapore. One of the top names in this is SE. I did get long some of this on the break of the value area. So again, I would rather be in some of these areas right now than in US growth stocks. One other thing that I'm going to leave you with, and I don't have the answer to this, and this is why patience is necessary, but provided that we get through kind of like, and by the way, let's look at the calendar to see what we've got ahead. So tomorrow you're going to get the PCE price index. So that's right in here. This is another gauge of inflation. This is the Fed's preferred gauge of inflation. However, the market doesn't usually move as much as the CPI, but it's another gauge of inflation. They're looking for 0.3, right? So that's the 28th. Around the weekend, we're going to get the last trading day of the month. That's going to be interesting because that's going to be quarter end. We are doing a webinar after the close on Monday. I haven't decided if I'm going to make that open to the public yet, but one of my colleagues, Webb Begol, who is the inventor of the MarketWebs indicator, we generally do these. We do webinars either whether it depends on the month, or we definitely try to do them at the end of the quarter and talk about what the charts are telling us. Then you're going to have the first trading day of the month, which is on a Tuesday. Usually there's new money being put to work on the first of the month. We'll see if that happens this time around. And then you have this tariff event for the second of the month. So, hopefully we can get through that. The tariff stuff, um, you know, let's hope that the current administration dials down some of that. They said that that's going into effect on the second. So maybe Trump can talk to some countries about negotiating that down. I still think they're leaving that open. Otherwise they would have just said, hey, we're putting it into an effect now. They're saying it goes into effect on the second or the third. So that leaves the weekend and it leaves a couple days. So maybe there could be some type of negotiation. Again, that's a somewhat optimistic view. You don't have to be optimistic like me, but I think that there's time for some of these countries to maybe take off their tariffs and then the US will take off theirs. Who knows? We'll see if that happens. And the question that I'm going to leave you guys with is once we come out of this, and we will, we always do, who's going to be the leadership going forward? You know, we've seen energy companies do well. We've seen financials do well. We saw cyber names do well for one day and then they collapsed. Um, so that's what I would be kind of focused on because I don't think it's going to be your old growth. You know, all those names that, you know, carried us in the years past. I don't think it's going to be AI names. I think we've gotten to a peak in that, you know, I've said this in time and time again. You could disagree with me, that's fine. But I think the growth has peaked out. I still think there will be AI and there will be some opportunities there, but I don't think that you're going to see the same type of leadership that we saw previously. I think it's going to come from someplace else. Where that happens, you know, that's something that that we may discuss in the webinar on Monday. Guys, have a great night. See you tomorrow.